Welcome to Dallas Stock Talk, where I talk about numerous investment opportunities, but more specifically the stock market. Now, in this video, I'm going to be going over 8 important metrics that all investors should know. Stay tuned. One thing before we get into this video, make sure if you really like the content, you hit the like button and you subscribe to the channel. First up, we have the P/E ratio. So the P/E ratio is a metric that allows you to compare the share price relative to their earnings. So if you're new to investing, generally speaking, the lower the number, the better. Now the P/E ratio is only valid if the company is profitable. So if not, we're going to have to use a different metric. Stay tuned. Next up is the PEG ratio. The PEG ratio allows you to compare the share price relative to the growth rate. So you can think about it like this. The lower the PEG ratio, the better, because it means that the share price is relatively more attractive relative to that growth rate. Now, if the PEG ratio is high, it doesn't necessarily mean that it's really bad. It just means that you're going to pay the share price is a little bit higher compared to their growth rate. Next up is the price to sales ratio. So the price to sales ratio is important because if the company is not profitable, the P/E ratio would be irrelevant because the company is not earning any money. So the next thing you can do is you can compare the share price relative to the amount of sales that they had. So it could be useful. Next up is the price to book ratio. The price to book ratio allows you to compare the share price to the amount of assets the company have. So if the price to book ratio was 2, that means that the share price is twice as much as the amount of assets the company has. Next up is beta. Beta allows you to determine the volatility of the stock relative to the broader market. Now, generally speaking, if the number is lower than 1, that means it's less volatile to compare to the S&P 500. However, if it's lower than 0, it means that it has an inverse correlation to the market. Next up is the debt to equity ratio. The debt to equity ratio allows you to compare the company total debt relative to the shareholder ownership. So generally speaking, the lower the debt to equity ratio, the better. Next up is return on equity. Return on equity allows you to see how profitable the company is relative to the amount of equity they have. And last but not least, free cash flow. Free cash flow allows you to know how much money will actually come into your pocket if you own the business. And that concludes Dallas Stock Talk. Make sure you let me know in the comments below what are some things that you like to pay attention to before you invest in a company.